So we have discussed about the bills of exchange in the previous lectures. In this lecture, we are heading toward the promissory note. So let's discuss about the promissory note. A promissory note is a written, unconditional promise made by one party, the maker or the debtor, to pay a specific sum of money to another party, the payee or the creditor, at a definite time in the future or on demand. This financial instrument is widely used in various contexts, including personal loans, business transactions, and financing agreements. So now we will discuss about the features of promissory notes. Promissory notes are widely used financial instruments that facilitate borrowing and lending arrangement between parties. They are characterized by specific features that define their nature and use in commercial transactions. So the first feature is the parties involved. In promissory notes, there are two parties that are involved or that are necessary to make a promissory note. The first is the maker. We also call it as debtor. And the second is payee. We can also call it as creditor. Now first, we will discuss about the maker or the debtor. The maker of the promissory note is the individual, company, or legal entity that issues the note and makes the promise to pay a specific amount of money to the payee. The maker assumes the role of the debtor in the transaction, agree to repay the borrowed amount according to the terms outlined in the note. The second is the payee or the creditor. The payee is the recipient of the promissory note to whom the payment is promised. Typically, the payee is the lender, creditor, or any party providing funds or extending credit to the maker. The payee holds the right to receive the specified payment from the maker as per the terms of the note. So, the second feature of the promissory note is unconditional promise to pay. A fundamental characteristic of a promissory note is the unconditional promise made by the maker to pay a specific amount of money. Unlike bills of exchange, which involve an order from the drawer to the drawee to pay a third party, a promissory note constitutes a direct commitment from the maker to the payee. This promise is legally binding and enforceable under applicable law. Another feature of promissory note is as it contains the specified sum of money. Promissory note specifies the exact amount of money that the maker promises to repay. The amount must be clearly stated in both numerical and written forms within the document to avoid ambiguity or misunderstanding. regarding the payment obligation. This clarity ensures that both parties are aware of the precise financial commitment involved. So moving toward the next feature, fixed repayment date or on demand. Promissory notes can be structured to specify either a fixed repayment date or to be payable on demand. So the promissory note can have either of the fixed repayment date or it will be payable on demand by the payer. And both of the terms depend on the consent of both the parties involved. The parties involved, as we have discussed earlier, is the maker and the payer. So if the maker and the payer both consented to make the promissory note as a term note or a demand note. So the term note is a term note stipulates a specific future date when the repayment is due. Let's take the example here for the term note. So a promissory note might state pay 10,000 rupees on December 31st, 2024. So this fixed maturity date provides clarity on the timeline for repayment. Now the second is the demand note. Alternatively, a demand promissory note allows the payee to demand repayment of the borrowed amount at any time they choose, without a predetermined maturity date. The flexibility of demand notes allows the payee to request payment when it is most convenient or necessary. And these two, the term promissory note and demand promissory note, can be made upon the consent of both the parties. So the next feature is its interest rate, which is optional in case of promissory notes. So promissory notes may include provisions for an agreed upon interest rate that the maker agrees to pay on the principal amount borrowed. This interest rate is typically expressed as an annual percentage rate. We can also call it as APR and represent the cost of borrowing funds, including an interest rate in the promissory note clarifies the financial terms of the loan and ensures that both parties understand the additional cost associated with borrowing. The another feature of promissory note is negotiability. It is also optional in case of promissory notes. Promissory notes can be structured as either negotiable or non-negotiable instrument. So in case of negotiable notes, to make a promissory notes negotiable, specific language must be included in the document, allowing it to be transferred to another party by endorsement or delivery. However, in many cases, promissory notes are intended to be held by the original payee until maturity, making them non-negotiable. Non-negotiable notes. So non-negotiable promissory notes are typically intended to remain with the original pay throughout the loan term. They are not designed for transfer to third parties and are enforced between the original parties involved in the transaction. If we talk about the legality of the promissory notes, the promissory notes are legally enforceable or legally binding. So first, let's discuss about the difference between the legally binding or legally enforceable. So promissory notes are legally enforceable document that establish a debtor-creditor relationship between the maker and the payer. So now we will discuss about the binding agreement, how the promissory notes are legally binding. So when signed by the maker, a promissory notes becomes a binding agreement or the binding contract that outlines the terms and conditions of the loan agreement. It specifies the obligation of the maker to repay the borrowed amount to the payee according to the agreed upon terms. So here a maker is legally binded to pay the agreed amount or the amount mentioned in the promissory note, and if the note is a term note, then on that specific date, on or before that specific date mentioned in the promissory note, the maker should pay that amount to the payer. And it is legally binding on the maker to pay that amount to the payee on or before the specified date, if mentioned in the promissory notes. Now we will discuss about the enforceability in court. So in case of default or non-payment of the terms or non-binding of the term by the maker, the payee can seek legal resources to enforce the term of the promissory note through civil litigation. Court can enforce the payment obligation and may award damages or other remedies to the pay as stipulated by applicable laws. So, how a promissory note can be a validating note. So, to validate the promissory note and make it legally enforceable, the document must be signed by the maker. The maker's signature specifies their acknowledgement and acceptance of the payment obligation stated in the note. The signature also serves as evidence of the maker's intent to repay the borrowed amount according to the terms specified. Now we will discuss about the features in depth through the importance of and uses of the promissory notes. The promissory notes play a significant role in facilitating borrowing and lending transactions across various sectors, providing a structured framework for individuals and businesses to formalize loan agreement. The importance stems from several key attributes that make them versatile and widely utilized in financial transactions. So now the first, as we have stated, the borrowing and lending. Promissory notes serve as a fundamental instrument in borrowing and lending scenario, enabling individuals, businesses, and other entities to secure financing or extend credit. These notes establish a formal agreement where the maker, also known as the borrower, promises to repay a specific amount of money to the payer, and we can also call as lender. So the borrower is the maker and the lender is the payer. So the two parties we have discussed earlier in the features, the one is the maker and the other one is the payer. So in case of borrowing and lendings, there are also two parties. The one is borrower and the other one is the lender. And the maker is as equivalent to the borrower and the pay is equivalent to the lender. This borrowing mechanism allows parties to obtain funds for various purposes, including business expansion, personal investment, education expenses, and emergency funding needs. So if we take example here regarding the promissory notes or the lending or borrowing scenario. As we have discussed, it is a fundamental aspect in case of lending and borrowing. Imagine a small business owner seeking capital to purchase new equipment. Instead of applying for a traditional bank loan, the business owner may enter into a promissory note agreement with an investor who agrees to lend the necessary fund. So the promissory note would outline the principal amount borrowed, the repayment schedule, any applicable interest rates, and other terms and conditions agreed upon by both the parties. And one of the other advantages of obligations. Collateral provides lenders with additional assurance of loan repayment and mitigate the risk of default. So if we take an example here, as we have taken the previous example, let's continue this. In the context of a small business owner acquiring new equipment, the promissory note could outline a repayment schedule that aligns with the business's cash flow projections. This might include monthly installment payment over a 2-year period with an agreed upon interest rate based on the prevailing market rate for business loan. So another feature if we discuss here is promissory notes serve as an essential evidentiary document that establish a clear record of the debt owed by the maker to the payer. These notes provide legal certainty regarding the terms and conditions of the loan agreement, which include the principal amount, the interest terms, and repayment terms or the default provisions. So if we discuss about the principal amount, it clearly specifies the amount of money borrowed by the maker. It also defines the applicable interest rate, if any. As we have discussed earlier, that the interest rate is optional in case of promissory notes. So, if there is any applicable interest rate on the promissory note, so it must include the method of the interest calculation and the specified interest rate are also should be included in the promissory notes. And in case of repayment terms, a promissory note must outline the repayment schedule, including the due date for installment payments or the maturity date for a lump sum payments. If we talk about the default provisions, so a promissory note includes provisions outlining consequences in case of default, such as late fees, penalties, or legal actions available to the payer. As we have discussed about the legal validity and enforceability of the promissory notes. So, to establish its validity, it must include the sign of the maker and the payer. And when properly executed and signed by the maker, a promissory note becomes a legally binding contract that can be enforced in a court of law. In case of non-payment or default by the maker, the payee has legal recourse to pursue remedies such as debt collections, asset seizure. Asset seizure is if collateral is involved. So asset seizure, if we describe here, means if we further explain the example we have taken previously, so in a small business, a businessman gives his a part of a land he owned as a collateral to the promissory note. Then, upon the failure of the repayment, the payee or the lender can seize that asset, that piece of land the businessman had agreed to be the collateral, is a part of legally enforcement. Or it can also include the civil litigation to recover the outstanding debt. This legal protection enhances the credibility and enforceability of promissory notes as secure instrument for lending and borrowing. A promissory note is an alternative to bank loans. It offers a viable alternative to traditional bank loans, providing borrowers and lenders with greater flexibility and control over the terms of the financial arrangement. So, unlike bank loans that often require extensive credit checks, collateralization, and approval process, promissory notes allows for streamlined transaction, customized term, and diverse application. So first, we will discuss about the streamlined transactions. Borrowers can expedite the borrowing process by negotiating directly with lenders, bypassing the bureaucratic hurdles associated with conventional lending institutions. The second feature is customized terms. Lenders have the flexibility to set personalized lending terms based on their risk tolerance, investment objectives, and financial goals. This flexibility encourages innovative financing solutions that cater to specific borrower needs. If we talk about the diverse applications of promissory notes, so a promissory note can be used for a wide range of financial transactions, which include personal loans between family members, corporate bonds issued by businesses, real estate financing, and private investment in startups or entrepreneurial ventures. So, if we take example here, or we will further take the same example we have taken earlier of a small business. So, for a small business owner, choosing a promissory note over a traditional bank loan can offer advantages such as faster approval, less stringent credit requirements, and the ability to negotiate favorable terms directly with the investors. This approach may be particularly beneficial for businesses seeking short-term financing or startup capital without the extensive documentation typically required by banks. So, as we all know that the traditional bank loans are a process of hassle or requires much more time. And in case of a small business owner, or in case of an individual, or in case of emergency funds, it is much more favorable to have a promissory notes than to go for a traditional bank loan. If we take another example of an individual, let's say a person asks, have an emergency requirement of funds for his mother treatment. So if he apply for the bank loan for the mother's treatment, then he must follow a structured process a bank defined for the loan. He must have a certain collateral which should be approved by the bank for the loan. But in case of promissory note, he can go to a person, a lender or the payee, and can get a personalized loan and with the collateral which can be accepted by the lender but not by the bank. So it is much easier for the person asks to have the amount of money as an emergency fund from the lender as a promissory note rather than the bank, rather than to go for the traditional bank loans, as it can consume much more time and can take several and have the several prescribed steps by the banks, which could be a hassle at the time of emergency. So we conclude the promissory notes, we can say that promissory notes play a pivotal role in modern finance by facilitating borrowing and lending arrangements that support economic growth, business development, and personal financial objectives. Their importance lies in providing a structured framework for formalizing loan agreements, offering flexibility in repayment terms, serving as evidentiary document of debt, and serving as alternative to traditional bank loans. By understanding the uses and advantages of promissory notes, borrowers and lenders can leverage these instruments to achieve their financial goals effectively and efficiently while maintaining legal compliance and financial integrity. Whether used for personal loans, business investments, or innovative financial solution, promissory notes exemplify their relevance as versatile instrument in the contemporary financial landscape. So, in summary, we can say that promissory notes are a fundamental financial instrument used in borrowing and lending transactions, providing a formalized framework for documenting and enforcing repayment obligation. Their features clearly ensures enforceability and flexibility in financial agreement between the parties. So this is all about the promissory note.